Hi, Jim Gore from THOR Wealth Management. If you like the videos, give us a like. Also, please feel free to share with your friends and colleagues. Today, I want to give an update on an investment that we still like in the client's portfolios, and this is Master Limited Partnerships, midstream gas and oil pipelines. And we've been asked, hey Jim, they performed very well the last few years. Why do you still like them? Well, that's what I want to show you. You're right. They have performed very well. If you look at since COVID, the pipelines have gone up 224% since March of 2020, compared to the S&P 500 of 67%. What this chart doesn't show, though, is the quarter before then, you had a lot of closed-end MLP funds that had forced liquidation of about $4 billion that drove MLPs down over 50% in the first quarter of 2020. So they became very, very cheap, and they've outperformed here coming out. So the question is, why do we like them now? Well, we did a video back in December 17th of 2020, which we're going to share the link at the bottom of this video for you. And you can see one of the things we like to look at is price to distributable cash flow. And if you look at this chart here, it is still cheap historically to buy MLPs. Even though they've had a 200% run up, they're still cheap on a cash flow. That's because the cash flows have really improved in these companies. And I'm going to give you an example of that near the end of this video. The other thing is you look at the S&P 500, energy companies in the S&P 500 right now are only 5.2% of the S&P 500 index. So energy companies are underrepresented. They've been up to, at times of stress in the oil markets, up to 16%, but it's a very low representation in the S&P 500. So if you're buying the S&P 500, you're really not getting exposure to the energy space. And in the energy space, in particularly, we still like the MLPs. And let me get back to why they're still selling at a discount. And this is a great example, and this is only one company. It's only one example. We're not suggesting that you buy this company at all. We're just saying this is an example of what we're seeing, and I can show probably 10 examples of what is happening in the midstream pipeline space. So we're looking at Plains All American. The symbol is PAA. And the top part of this chart, you can see that the company's performance since COVID, since March of 2020. The quarterly dividends have gone from 18 cents a share to 26.8% cents per share. That's a 48.9% increase in dividends, income to you as an investor. Shares outstanding. Shares have gone from 727 million to 698. 4% reduction in the shares. So they're buying back shares. But at the same time as they're buying back shares, they're increasing the dividends. They're paying off debt. They paid over $2.2 billion worth of debt, almost 23% fall in long-term debt at Plains All American. And then look at the cash on hand. The cash is up 9.5 times what it was back in March. So here's a company that has paid off debt, has increased the dividends to you, bought back shares, and has more cash on hands for more distributions to you as a shareholder, or to buy back more shares or pay off more debt. So the company is doing extremely well, and these fundamentals are very good. Because the company is doing very well, and the stock price has done well, the stock is still selling at a discount compared to the S&P 500. So you look at the PE ratio. The PE ratio of Plains All American is 10.92. The SPY, which is the S&P 500 ETF, is 20.29. So it's 47% cheaper on a price earnings ratio basis. Next thing is, let's look at the dividend yield. And especially if retirees looking for income, Plains All American paying 8.24%. S&P 500 is 1.89%. You're getting 4.4 times more income to you. Just on the income alone, you're going to be doubling your money in 8 to 9 years on the dividends on PAA. Spider, it's going to take you a long time to get that money back, to double your money if you're just relying on the dividends. So we still like MLPs. And we still like the energy space. We just like the MLPs as the best way to play the energy space, because no matter what happens to the price of oil and natural gas, they're still going to have to get them go through the pipelines. And we saw what happened in East Palestine here in Ohio, why it's important to have pipelines instead of railroad cars. If you have any questions or concerns, as always, reach out to us at thorwealthmanagement.com. Look forward to talking to you in a couple of weeks. Take care.